Professor Barati here. Let's go over our chapter 14 and 15 on variance analysis. I know this says chapter 16, and this is from a undergrad class, and I like these lecture notes a lot more than our graduate book lecture notes, which I think are not as good. So I want to go through the lecture notes quickly and then show some examples and problems on how to compute variance analysis. Variance analysis is really just math with some theory behind it. So let's get the theory down, which is very logical, and the math is very logical. And so what I will try to do is get through this quick, and we'll get through the problems quick. So why are we doing variance analysis? Particularly in manufacturing, but it's also can be done in service companies as well, because after all, like I said, when we started the class, every product and every service has a cost. Companies basically need cost accounting regardless, and therefore behind those costs are the basic quantity and price. And so we do variance analysis because when we prepare budgets, we not only want to see how we perform against the budget, but we want to see if we're efficient in performing the budget, how efficiently we perform, and whether the efficiency or variance to budget was driven by a price or a quantity. So again, the budget is the high end, but when we drill down on what really caused the differences between actual performance and budgeted performance, we drill down those numbers to see if it was driven by price or quantity. So the learning objectives, primarily we're going to focus on developing and using flexible budgets. We're going to compute and use variable cost variances and compute and use fixed cost variances, and understand how a standard costing system works. Before we get into the variance analysis and some of the number crunching, let's just talk about standard costing system. In a manufacturing company, especially with process costing involved, like a Coca-Cola or a large, let's say a tire company that makes 15 different types of tires or so on. Companies use what's called standard costs. With the help of the operations department, engineers, and cost accountants, and even salespeople, at some point a company can basically determine that it normally under efficient and budgetary ideals, it would take so many hours to produce a widget. It will take so many direct labor hours, so much material, and so much overhead. Those items that make up the product cost, for example, a product might have 15 or 20 different parts to it. At the beginning of the year, the planning stage, the budget, standards will be developed on what those parts should cost. And those costs per part A, part B, and part C are essentially put into your accounting system. So every time you start production, those costs basically will credit direct materials and debit WIP for the same standard price throughout the cycle. Therefore, while this is done for efficiency, in other words, you wouldn't be able to get your financial statements done quickly. You wouldn't be able to have a financial system if you had to wait for all your actual costs to hit your books. So the standard cost is really basically done for expediency and efficiency. However, the actual costs eventually work their way into the system, and we have to record our costs with actual costs, not so much standard. So at the end of a period, whether it's a month, a quarter, a year, we have to reconcile the actual costs to the standard, whether they're higher or lower. That reconciliation process is basically variance analysis, the difference between actual and standards. And to do that, we create flexible budgets. So moving along, the key concept is the use of budgets for performance evaluation. We learned about the master budget. We learned about financial and cash budgets and so on. The budget serves as a benchmark for units of the firm or for organizations that do not routinely prepare public report. The budget is management's plan for financial performance. The master budget includes operating budgets, which is essentially our budgeted income statement or contribution margin statement. Financial budgets are basically cash flow budgets and balance sheet budgets. When management uses master budget for control purposes, it focuses on key items that must be controlled to ensure the company's success. A variance is the difference between a planned result and an actual outcome. Variance equals actual minus budget. So, variance analysis is used to evaluate the performance of individuals and business units, and it identifies possible sources of deviations between budget and actual performance. A favorable variance is a variance that, taken alone, results in addition to operating profit. So if our expenses are lower, if our actual cost is lower than our budgeted cost, that is favorable. That's a favorable variance because lower cost adds to our operating income. Conversely, an unfavorable variance would be when our costs exceed budget. When we're analyzing revenue, it's the other way around. When revenue is greater than budget, it's favorable. When revenue comes in less than budget, it's unfavorable. The labels of favorable and unfavorable should not be considered as evaluations of performance without additional investigation. An important part of variance analysis is to understand what might cause a difference between actual and budgeted results, and what portion of the total profit variance is due to each cause. A simple, straight, actual to master budget income statement with units on top here is as follows. Actual sales were $18,000 less than master budget. Therefore, revenue is lower. A lower revenue reduces operating profit, so it was unfavorable. In this case, direct materials was $7,200 greater than budget. $7,200 less than budget. Therefore, that was favorable. Direct labor was $3,000 over budget. It was unfavorable. Variable overhead was $1,000 below budget. Therefore, it's favorable. Total variable costs were $5,200 less than budget. Therefore, that's favorable. Our contribution margin, which is a calculation, the difference between our revenue and our variable costs, was $12,800 under budget. Contribution margin is the cost of sales minus our variable costs. So essentially it is a netting of a revenue. against expense. The contribution margin was $12,000 under budget. Therefore, like revenue, it's unfavorable. Fixed overhead and expense came in under budget, therefore it's by 600, therefore it's favorable. So it's basically a simple concept between favorable and unfavorable. Flexible budgets. A static budget is developed in detail for one level of anticipated activity, such as a master budget, which is what we just did. However, we introduce a flexible budget, which indicates budgeted revenue, costs, and profits for all feasible levels of activities. So in other words, we have this master budget, but we will have different volumes throughout each month. So one month we might produce 2,000 units, another month we might produce $2,200 of units, another month we might produce 3,000 units. So with different volumes of activity, our master budget basically is converted into a flexible budget. We use the standards that are embedded in the master budget, but we take those standards and say, what would our budget look like if we budgeted these units? What would our budget look like if we had 3,000 units produced or $4,000 a unit produced? What would our budget look like if we had 1,000 units produced based on standard costs? And that's what a flexible budget is. It's basically asking the question, okay, we budgeted 2,000 units, but we produced 3,000 units. Therefore, what would our budget have looked like with standard costs if we used 3,000 units? So it's being flexible. So if you're having trouble with what a flexible budget is, that is it. Just ask the question, what would our budget look like using standards at this level of activity? So total budgeted costs equal budget fixed costs plus budget unit variable costs times the number of units, which is your total budgeted cost. A flexible budget is an estimated cost volume line because it shows the budgeted costs allowed for each level of activity. A sales activity. What is a sales activity? It's the difference between operating profit in the master budget and operating profit in the flexible budget. That arises because the actual number of units sold is different from the budgeted number. So sales activity variance is the difference between the flexible budget, which we have to basically convert and compute, versus the master budget. It's based on activity. So it's based on actual activity minus the budgeted activity or planned activity. So don't let the word sales activity confuse you. We're not dealing with just sales. We're dealing with the income statement. The sales activity basically should say volume activity. That's what probably the proper definition or heading should be. For the sales revenue, the flexible budget is simply the budgeted unit price or a standard cost price times the actual units, and the static budget is the standard cost price times the budgeted units. And similar for variable costs, except you're using cost information. So I'm going to scan over this a little bit because I think it's confusing. and get to a problem. Also keep in mind, in the homework there's a standard cost sheet which basically gives us standard quantities of inputs for direct material, labor, and variable overhead, and also standard prices. In many problems in cost accounting, you're going to have to basically figure out what the standard input is and the price per input. So standard cost per unit of output is the standard input price or rate per unit of input times the standard quantity of input per unit of input. So it could be basically pounds. You might need 1,000 pounds to produce a particular product at $2 a pound. Or you might need one part to produce, or for example, you might need 2 tires to produce a bicycle at a cost per tire. Multiply those two to get your total standard cost for the unit. But what you will see in doing variable costs, we're not going to use the unit cost so much. We're going to be concerned about the standard input, the number of pounds, the number of grams, the number of hours, times the number of quantity to make that one product. So going forward, we have cost variance. The cost variance uses a model that compares actual input amounts and prices with standard input amounts and prices. Now, every variance between actual and budget basically has a flexible budget in the middle. So the difference between your actual and your flexible is going to be your price variance. And the difference between your flexible and budget is going to be your efficiency variance, which is also similar to what we just mentioned above as the sales activity variance. The difference between flexible and a static budget is a sales activity variance. The price variance is a simple formula. Actual price times actual quantity minus standard price times actual quantity equals actual price minus standard price times actual quantity. Therefore, just ignore everything to the left of the equal sign. The formula is really actual price minus standard price times actual quantity. An efficiency variance is the difference between budgeted and actual results arising from differences between inputs that were budgeted and the inputs actually used. This is where the flexible budget will come in. Essentially, the efficiency variance is the actual quantity minus standard quantity times the standard price. The total cost variance is the difference between budget and actual results, and essentially the addition of the price variance plus the efficiency variance. Price plus efficiency variance is going to equal your total cost variance. This is the model you want to use, and it will help you do all the calculations. The actual cost equals actual input of quantity at an actual input price. So it's actual price times actual quantity. Your flexible budget is basically your standard quantity input. How many grams or how many pounds are required to produce your widget, allowed for an actual output at standard input price. So it basically takes what your your input would be. If you know you're using 2 pounds to produce a unit and you're producing 10,000 units for that month, you're going to use a flexible budget to calculate that. Essentially, you're asking what would our budget be based on this volume that we actually achieve. This middle calculation is basically your standard price times your actual quantity. So the difference between the actual and the actual input at standard price is your price variance. The difference between the actual input at standard price and the flexible budget is your efficiency variance. These two added up equal your total cost variance. Your total cost variance is basically the difference between this column and your flexible budget. So whatever number is here minus this number is your total cost variance. The difference between this column and this column is price, and this column and this column is efficiency. A flexible production budget is calculated as standard input price times the standard quantity of input allowed for actual good output. Do not confuse this with the static budget. The number of units you budgeted for the month do not go into this calculation. It's how much of this material or how much of this labor should we have used based on the actual quantity. So let's go to a quick demonstration problem. We're given a cost sheet, a standard cost sheet. It gives us 2 units per truck at $2.50 per unit, equals $5 per truck. The trucks produced in October were 10,000. Actual materials purchased and used were 22,000 units at $2.40 per unit. So, essentially, prepare a truck's division's direct material variances for the month of October. So let's look at our calculations here. You're going to have a column that says actual costs. Your actual price is going to be $2.40 per unit. And your actual quantity is 22,000 units, which is given to you. Equals total material cost of $52,800 actual. On the flexible budget side, which I recommend you do after the actuals, you're going to take your standard price times a flexible quantity. So, it takes 2 units per truck. 2 units per truck. This basically is irrelevant to us, right here, the $5. What's relevant is it takes 2 units to make a truck of this particular material. We produce 10,000 trucks. Therefore, under this volume, we should have used 20,000 units, which is our standard quantity. So $2.50 times 20,000 equals a total cost of $50,000. Do not use what was budgeted, and do not use what was actually incurred, 22,000. What you want to know is we produced 10,000 trucks. It takes 2 parts per truck. Therefore, we should have only used 20,000 parts to make 10,000 trucks, but we used 22,000 parts. Therefore, we have a variance. The middle column is simply a formula. Standard price times actual quantity. Do the middle column last, because to do the middle column, you need to get the components from the actual side and the flexible budget side. So you know your standard price of $2.50 times actual quantity is 22,000. So the difference between the actual costs and the actual input quantity times standard price is $2,200 less than this column. That's your price variance. Then look at this column's variance of 55,000 compared to your flexible budget. It cost us more on the quantity side than it should have. So we were less efficient. It cost us $5,000 more than the flexible budget. Therefore, our efficiency was lower. Why was it lower? Our cost per input was the same. What caused it was the difference in the quantity. So what this side does, the efficiency, is it tries to figure out what quantity drove the variance, and on this side we figure out what happened in price. Notice quantity and quantity are the same, but price is different. It's 10 cents less than the standard. Therefore, what drove the price is the price. Notice from the middle to the right, the standard price was the same. So that's not what's driving the variance. What's driving the variance is the difference between the quantities. So a $2,200 favorable variance plus a negative efficiency variance gives us an overall total cost variance unfavorable of $2,800. To prove that, just simply take the actual on the left column, compare it to the cost on the flexible budget. The difference is exactly $2,800. Now we could do the same for direct labor. In our problem, we're giving some direct labor problems here. Actual hours worked were 5,000. Total actual labor cost is 51,000. Average cost per hour is $10.20. Essentially, you have the whole left side of your equation right there. $10.20 times 5,000 actual worked equals actual cost of 51,000 in direct labor. Now let's figure out our flexible budget side. We are told that direct labor is $10 per hour, so our standard price is $10. But we have to figure out how many hours should we have incurred producing 10,000 trucks. If it takes 0.4 hours to produce one truck, then it takes 4,000 hours to produce 10,000 trucks. We should have only incurred 4,000 hours to produce 10,000 trucks, but we actually incurred 5,000. So we're going to have a quantity variance. To do direct labor is exactly the same way we did materials. You take the price variance, which is the difference between the 51,000 and the 50,000, and what's driving that is simply $10.20 minus $10, which is 20 cents, times 5,000 units gives us 1,000 unfavorable because our costs are higher. Then we take our middle column, which is standard price, which is right here in our flexible budget, times actual quantity, 5,000. The difference between 51,000 and 50,000 is 1,000 unfavorable. Now let's calculate our efficiency variance when it comes to direct labor. The efficiency variance is 50,000 minus 40,000. So essentially we had $10,000 more variance due to quantity because we isolate the standard price of $10 per labor hour the same. The difference is exactly 1,000 units, or 1,000 hours, I'm sorry. It costs us, we used 1,000 more hours to produce tires than we should have. So we were less efficient. Therefore, we have an unfavorable variance of $10,000. The total cost variance is 51,000 minus 40,000. So our labor was higher than flexible budget. We were less efficient, but we were less efficient. We produced more labor, direct labor hours, and it cost us more. So we had two variances that add up to our total cost. Next, let's go to our variable overhead calculation, which is going to be the same as materials and direct labor, except we're going to apply it. We're going to use applied overhead. So in this same problem, we are told that variable overhead is as follows. The standard costs 0.4 hours per truck at $5 an hour. Trucks produce at 10,000. Actual variable overhead cost is 23,000. So the key here to know is, how do we apply overhead? The problem doesn't really tell us, but I guess we have to assume it's based on direct labor hours. So the actual costs are given to us at 23,000. For our flexible budget, our standard costs, it takes 0.4 hours to produce one truck. Therefore, it should have taken just 4,000 direct labor hours. Our cost per hour is $5 under variable costs. The middle column then can be computed as standard price times actual hours. So $5 times 5,000 actual hours used, which is basically they're taking that from the problem above, direct labor. So direct labor hours were 5,000. So again, the price variance is the difference between this column and this column, which is favorable because costs were lower. However, this column versus our flexible budget is higher by 5,000, therefore it's unfavorable. The total cost variance is the net of the two, which is 3,000 unfavorable, or just look at the difference between the actuals and the flexible budget. Fixed costs are a little different from this matrix. Compute and use fixed cost variances. Basically, fixed cost has no input and output. Okay, it's not materials, it's not labor, it's not variable overhead. It's basically just costs. So we have actual and flexible budget. Basically, when companies use full absorption standard costing, fixed production costs are unitized, and therefore we have variances. So we have to know what our budgeted fixed manufacturing overhead is and our budgeted activity level to come up with our predetermined rate, which we covered in class. Once we have that predetermined rate, we have to figure out what are we applying fixed overhead to. Is it based on direct labor hours or machine hours? So basically our three columns, unlike the variable costs, under fixed costs we have our actual and a budgeted, and then we have what's applied. The difference between actual and budgeted is our spending variance, The difference between the budgeted and applied is our production volume variance. So to demonstrate, annual budgeted data is $115,200 of fixed overhead. So the budget you would expect here to be $115,200, but we're doing it for the month of October. So it's $115,200 divided by 12 months. And just to make sure that's right, divided by 12 is $9,600. So that's your budget. Actual costs are given to us in the problem, $9,000. The trick here is the applied. How do we get this $2? Let's look at our fixed overhead budget for the year was $115,200 divided by our budgeted direct labor hours of 57,600, which is the $2. Therefore, our predetermined rate is $2. We're basing it on a standard cost. It takes 0.4 hours to produce a truck. We produce 10,000, so we're applying it based on hours, direct labor hours. If it was machine hours, we would apply it based on machine hours. So 2 times 4,000 equals 8,000 applied. Simply take the difference between actual and budget, which is your price variance. It's favorable by 600. And your budget to applied, which is unfavorable by 1,600. Recording costs via journal entries. When we have these calculations and variance, we actually produce journal entries. Okay, so with direct materials, we will debit work in process by the standard. We record our material price variance, our material efficiency variance, and the credit is accounts payable. Now, this is basically an intro. We will, in another chapter, basically figure out that this entry isn't exactly correct. The correct way to record this is to record the material price variance at the time of purchasing direct materials inventory. So this material price variance will be calculated at the time we purchase materials, not at the time we put materials in production. Direct labor. You would debit work in process inventory for your flexible budget amount. You would credit wages payable under the actual amount, and direct labor and price variance and direct labor efficiency variance would also be debited or credited based on whether they were unfavorable or favorable. Variable manufacturing overhead is 2 steps. You would record work in process inventory, debit that by the variable overhead applied, which is your flexible budget, and then variable overhead actually incurred would go to work in process as well. That would go to variable overhead actual or control and credit your miscellaneous payables. The next step would be to close your applied and your variable overhead accounts. You close them. You debit and credit the other one, and your differences are your variances in your variable overhead. All these numbers can be picked up right here in these matrices that we just did. So in this case, you would basically debit, let's go to direct materials first. In this case, you would debit WIP for $50,000. You would credit your payables for $52,800. Your price variance is favorable. What it's saying is, basically, what it's saying is that our cost of goods sold based on standards is too high, because we're using $2.50 as our standard, but our actual material cost was $2.40 per input. Therefore, our standards are running through our inventory and into our cost of goods sold at $2.50 per unit, when it should be running at $2.40. Therefore, we have a favorable price variance. And we basically have to adjust our cost of goods sold at the end of the period for that. So the price variance would basically go in as a credit, and the efficiency variance would go in as a debit to balance our entry. And I will show you this in a live example, a better example than these. So basically, these are the journal entries that you would have to make. The debit to price variance and efficiency variance in this problem is for show only. There could be debits or credits depending on whether they're favorable or unfavorable. So this is in Canvas as a lecture note. I suggest you read this and carefully and go through some of the problems at the bottom. They have answers for you, and you'll get the hang of it. So this concludes the lecture for variance analysis. There'll be another video on a problem with journal entries.